Hello, welcome to another episode of Money Script Monday. My name is Brian Manderscheid. Today we're going to talk about the costs associated with an indexed universal life policy. Now, if you do an internet search on IUL costs, you may find some articles, likely bias articles from people trying to sell you other vehicles, whether those are mutual funds or maybe even a whole life policy, about the number one reason why not to buy an IUL, which are the policy costs. My goal here today is to describe to you what the policy costs are in an IUL, talk about some alternatives that you may be considering, as well as give you enough information to determine if an IUL policy is right for you. Now, when you go to make another important financial decision, not a financial vehicle, but an automobile, it's typically easy to look at different product features and benefits, whether it's miles per gallon with fuel efficiency or whether it's the size of the engine with performance. It's typically easy, whether online or going to the dealership, lifting up the hood, going for a test drive, to compare different vehicles side by side. With financial vehicles, it's often difficult to get a financial advisor to disclose and describe the fees associated with the vehicle that you're describing, as well as to look at some possible alternative options and how they stack up. So the types of IUL policy costs, two things I want to mention. Number one is the fact that these are going to differ from company to company. The second thing is all these fees will be fully disclosed upfront and be transparent. So the two types of costs you'll see inside an IUL are number one, fixed, and number two, variable. The fixed expenses are going to be based on the policy you buy and not going to change. So number one is a premium load. This is deducted right from the top of the premium you pay into your IUL policy, and it's going to go to any state premium taxes if applicable, and also to the insurance company profitability. The second fixed type of cost we'll see is an administration fee, which is typically a nominal amount that will exist for the life of the contract. The second type of fees that we'll see in an IUL are variable expenses. These are based on your age, gender, and health, as well as the death benefit amount that you purchase. It's very important to note that when we're building an IUL policy for cash value growth and tax-free income, we always want to buy the least amount of death benefit that the IRS will allow and fund right up to the maximum guidelines. This will ensure that we can minimize these variable expenses so that a majority of your premium goes to cash value growth and less of it goes to policy expenses. The first type of variable expense is an expense charge. This typically lasts for 10 years and is front-loaded in the contract. These go to the acquisition costs that the insurance company has, whether that's all the medicals that they have to order, getting doctor's records, and even paying a commission to the agent. The second are the mortality charges. These are the pure mortality costs which are used to basically cover the death benefit for your family, your business, or maybe even your favorite charity. And lastly, surrender charges. While these typically don't apply, if you were to walk away from your contract in the surrender charge period, you may have a cost associated with that. It's typically a 10-year schedule, being a declining schedule, meaning that they'll be higher in the initial years and lower in the last years. We know that life happens and potentially you could surrender a policy. That's obviously not our intent, and we would like to obviously have this policy for life. So we talked about the types of policy fees that are associated with an IUL. Let's now look at a comparison of what those fees may look like. So in green, you'll see the IUL policy costs. In blue, you'll see a hypothetical alternative with a 1% expense and no taxes. In red, you'll see a hypothetical alternative with 1% fee and 25% in taxes. It's important to note that your tax rate may be higher or lower and that these numbers will differ based on your exact tax rate. Also, in this example, we're assuming that the vehicle is taxed as earned on each of the year's annual gains. So a couple things to point out. You can see up front right away, the IUL costs are higher than the alternatives. However, over the long run, you can see the IUL costs are actually lower than the other alternative options. You'll also see some crossover points in the latter years where the cumulative expenses at 1% of the alternative with no taxes actually becomes more costly than the IUL. Likewise, you'll see that in the same scenario with the 1% fee and taxes scenario, Obviously, that happens much sooner when you have both fees and taxes associated with the alternative. A couple things I want to point out. Obviously, the fact that with the IUL, the policy costs are front loaded, likely when you need the money in the policy the least, whereas they are lowest when you're likely to need the money the most. In the alternatives with fees and taxes, you can see that they start off lower when your account value is small, but once your account value starts to rise, and over the years, the fees that you're paying and the taxes will actually exponentially increase, so that the fees and taxes you're paying are likely to be highest when you need the money the most. So let's look at an actual example of a 45-year-old male in good health. Now keep in mind that you may be a female, or you may be older or younger than this individual, or in better or worse health. These numbers basically just are hypothetical scenario of what they will look like, what the fees will look like, as well as what they stack up against on the alternatives. What I did here was I looked at the annual policy fees as a percentage of our account value. So for example, if we had $1,000 in charges with a $100,000 account value, our fees would be 1% of our account. In looking at the IUL, the first policy year, the worst year that we'll find, the total fees as a percent of our account value is actually almost 10%. I would say that's definitely high in the first year, and if you're looking for a good first year return or short-term investment, the IUL is definitely not what you'd want to consider. However, in the 10th year, we're about 1.5%, which I would say is still a little high, but if you compare those to the alternatives that you may consider, let's say you're investing in actively managed mutual funds and paying an advisory fee, you may likely be at 1% or 1.5%, if not higher. Now in the 20th year, we're at 75 basis points, 0.75%, and now we're starting to get to the point where the fees are actually lower than many of the alternatives that you may be considering. And then in the 30th year, the fees are actually 13 basis points, that's 0.13%. Now we're getting very cost efficient. All we have at that point are the policy administration charges and some small amount of cost of insurance, and we're very cost efficient at that point. In the 40th year, the average over the 40-year time frame is 1.04%. So for this 45-year-old male, over his lifetime, he's paying about 1% in fees, and it's important to mention the majority of those fees went for a death benefit for his family, maybe his business, or maybe even his favorite charity. Now when we compare those the same two alternatives, a 1% fee, no taxes, and a 1% fee and 25% taxes, obviously the fees at the 1% are the same at 1 each and every year in the average. Now when we look at the fees and taxes scenario, again, keep in mind that if you are in a higher than 25% tax bracket, these numbers will actually be much higher than shown here. In the first year, the fees at 1% plus taxes at 25% are actually 2.4%. Again, pretty expensive, but it actually gets worse with the larger your account value grows to, the more fees and taxes you'll be paying. In the 10th year at about 6.5%, the 20th year 10.5%, and in the 30th year we're actually over 16% with the taxes and fees you'll be paying in this alternative. Over 40 years, you can see the average expense as a percentage of our account value is over 11%. So you can see that if you are paying fees on your investments and paying taxes on those gains, the fees are actually extremely high over the years. Now to sum up what we talked about today, we talked about how, again, not everything you read on the internet is true, and it's important to work with a qualified financial advisor who's going to accurately describe and disclose to you what the fees are and how those may stack up next to alternatives. We talked about what the types of policy costs are, both fixed and variable. And lastly, we talked about the policy costs themselves, how they stack up to alternatives. We determined that the IUL actually has higher costs up front because of the front-loaded nature. In the long run, they're actually very efficient and at par, if not lower, than alternatives that you're considering. Thank you very much for tuning in to another episode of Money Script Monday. My name is Brian Mandershot again. Thank you so much. Bye-bye.